Wall Street's favourite trade assumed Trump always blinks, but has it been exhausted? For the past 9 months, one of the most profitable bets has been the so-called taco trade, short for Trump always chickens out. Investors are learning to shrug off aggressive policy threats and keep buying risk, but that trade may be running into trouble. If markets no longer sell off hard enough to force a retreat, is it time for a new strategy? Joachim Klement is head of strategy at Panmure Liberum. So Joachim, Tuesday's sell-off may be the clearest sign yet that taco's immunity is fading. The S&P 500 wiped out its 2026 gains. So is this strategy no longer a safe bet?
Well, I think that what we've learned at the beginning of this year is not only that Donald Trump will come back and then might chicken out if the market reacts too badly, but importantly, that he will come back. And so I think the market now is in a position where it says Donald Trump might have reversed course this week, but we have no idea when he will come back, whether that is in a month or in 3 months or in 6 months' time.
Meanwhile, hedging against an equity sell-off has fallen to some of the lowest levels in years, as according to the latest Bank of America survey. So are investors dangerously unprepared?
I do think that there's a lot of optimism going into 2026, particularly about certain parts of the market, obviously the tech space in the US. But we also do see a broadening out of the rally. And I think there are opportunities outside the tech space in the US where there is good money to be made.
Well, Ray Dalio says that global investors are diversifying away from US assets. Will that shift accelerate as tariff threats remain a core part of Trump's playbook?
Absolutely. Whenever we talk to major investors in Europe or Asia, the diversification trade away from the US, not abandoning the US, but diversifying away from it, is top of the list of things to do in 2026. And that should lead to continued downward pressure on the US dollar in particular.
Let's talk more about that diversification. And some expect European stocks to ride out trade and geopolitical tensions. Is Europe the most compelling alternative?
I do think that for 2026, Europe is a compelling alternative. However, Europe has its own problems with a lack of GDP growth outside of Germany's infrastructure boom and the overall defense boom. So overall, I think diversification in the sense of betting on different horses is really key for 2026 because we expect European markets to have similar returns to the US this year.
So finally, Joachim, earnings season is picking up. We've already seen Netflix and Intel disappoint with weak outlooks. Has the bar been set too high for companies to clear this quarter?
There is definitely a so-called Q4 effect where companies tend to disappoint more often in the fourth quarter results. That is simply because the attention of investors is already focusing on 2026 and the guidance. And I don't think that this earnings season, early as it is any way different from other earnings seasons. The key really is what kind of guidance do these companies give for the coming year.
That was Joachim Klement from Panmure Liberum. Don't forget you can watch more videos on Reuters.com.